Hey everyone, welcome back. We got to cover some important catalysts, and I recommend you write these down because they're going to be stock market shakers over the next week. We'll also talk about some of the implications of what happened in the bond market after Jackson Hole, and let me just say it's not what I expected the bond market would react as. So let's hit the numbers here. First, we're going to have JOLTS data coming out on Tuesday. Mark your calendar for Tuesday morning. We're looking for 9.45 million. Any softening here in the job openings and labor turnover survey is actually going to get us closer to the end of the hiking cycle. Remember, Jerome Powell in Jackson Hole made it clear that even though we don't want to see unemployment rise, we do want to see the pressure on jobs and wages continue to slow. So that way wages could go up at a stable level, but not overheat the economy. And so we are on the track of slowing down. Less job reports, as in less hiring and less job openings, but it's not decelerating as quickly as we expected. And that reiterates the need for, well, in Jerome's view, higher for longer. So really what you want here is you want this number to come in soft. You want to see that 945 come in under to be a positive catalyst. Although last month's jobs data came in stronger than we expected. A lot. We basically almost felt like we had a blowout, especially in those ADP numbers. Speaking of which, on Wednesday, we'll get our ADP numbers. The ADP numbers are expected to come in at 198,000 jobs added. Last time we had a blowout at 324,000. That comes out at 5:15 a.m. California time on Wednesday. Then we'll be looking at GDP annualized, which comes out next week as well. The annualized figure for GDP we're looking for is 2.4, obviously well away from recession. Germany just had its last quarter GDP come in flat just yesterday morning, and helping them maybe say, hey, look, this recession is really shallow because they've already had a few quarters of negative GDP. Anywho, focusing on America here, we'll get our GDP annualized. Obviously, we're not close to a recession at the very moment. In fact, yesterday I was going through some of the real Fed Now sort of current estimates for GDP, and I mean, we know they're sitting at 5.9% in terms of what GDP might actually be right now. It seems a little ridiculous. I went through what some of the drivers of that were, and the drivers, probably the biggest driver that really drove that number up the most was the day we incorporated the retail sales data. We actually had a pop-off in the real GDP chart, and that's because it's one of the factors in it. So this is so weird because you have Capital One and Target and Home Depot and Amex talking about a slowdown in expenditures for people, both discretionary and non-discretionary. Affirm is talking about more travel and entertainment spend, so maybe people are spending more over there, but a lot of companies reporting about a slowdown in June and July. Affirm doesn't seem to see it. The retail sale numbers for June and July don't seem to imply it. So we're kind of scratching our heads right now going, so is the consumer out of money or is the consumer not out of money? It's really bizarre. But either way, we'll get our GDP figures next week. Then we're going to get PCE, the Fed's preferred inflation gauge, on Thursday. We're looking for 0.2 core month over month and 0.2 headline month over month. Friday, we'll actually get the real jobs report. Real. I mean, I'm going to put a little asterisk on that because we know they revise this crap all the time. The first 6 months, for example, of this year, they subtracted another 300,000 jobs. So it's kind of like the numbers come in hot, the Fed hikes more, and then all of a sudden the numbers get revised down, and it's sort of like, obviously some people on the anti-Biden side are like, they're rigging the numbers because nobody talks about the revisions. People just talk about the headline, and he wants to cheer Bidenomics. Other people on the left say, no, this is normal. There are always revisions, and when you're in uncertain times, the revisions are larger, and when you're in a decelerating economy, of course, those revisions are going to trend to the downside. Wow, we are going in for a big bank angle here. Look at that for a moment. Can you get a focus on that? Yeah, you can kind of see it. That looks kind of cool. Big old turn. Anywho, okay, so that's those are the catalysts coming up next week. After that, obviously the most important ones. Oh, and of course on jobs. Yes, even though we want people to have jobs, you want this number to start coming in below trend. Trend right now is about 180,000 jobs. Anything below trend is going to help reiterate to J. Powell that, okay, good, we are we're good. Maybe we don't need to hike more, right? Anything above trend of about 180,000 is going to reiterate, okay, maybe we need one more hike. We're expecting 168. So that's Friday. Friday morning, we'll have that jobs report, 5:30 a.m. California time. So we want this to be below trend, but ideally we don't want it to be negative. Negative is going to be recessionary, right? Now, it's lagged. Jobs data is always lagged, so it's not a great leading indicator, but it is an indicator that the Fed is going to use to determine, okay, how much stronger do we have to go here, because we keep pushing on this jobs number, and the more it doesn't go down, the more we think we have to raise rates and stay higher for longer, right? The real big catalyst, obviously, is going to be September 13th, though. That's CPI day. No estimates for that yet, but obviously we want to see that come in low. Duh. That's on the 13th. Then the Fed meeting is September 20th. This is going to be a big one because it's a summary of economic projections meeting. We did not get a SEP, summary of economic projections, in the last meeting. So we're going off the June SEP right now. But the next SEP will give us another reiteration of, okay, we're probably going to pause, but what's your long-term outlook for rates for the end of the year and the end of next year? And that's really going to forecast how many cuts is the Fed actually pricing in for next year. So that's going to be a big day. September 20th, buckle up. That's going to be a big day. We're going to look at that step where we'll be like, oh my God, the Fed's not pricing in any cuts. We're screwed, right? That'd be a problem. Then, of course, we do have Loretta Mester coming out saying, hey, you know, the worst mistake we could make is over-tightening. Or sorry, the worst mistake we could make is under-tightening. And that is a worse mistake than, quote, over-tightening a little bit, because we can correct that. Yes, so this is why the bond market, I think, is reacting the way it is. How did the bond market react after Jackson Hole? Well, the bond market said, okay, we'll price in another rate hike. And that's basically what they did. We went from a terminal expected lower bound rate of 5.34, which was pricing in like a 10% chance of a rate hike, and then all of a sudden just skyrocketed up to 5.48. So we added another like 10, 11 bips right there, which is basically pushing you up to like a 30-40% chance of another rate hike by the end of the year. And getting to terminal. So getting to that terminal rate. So anyway, that at the same time also led the yield curve to unfortunately steepen. I'm sorry, not steepen. Steepening is getting better, right? Remember, we have the spread between the 210. So remember, when it steepens, you're generally getting closer to uninverting. But this actually inverted more. It went deeper, not steeper is the right word. So deeper is the opposite of what has been happening over the last few weeks. Over the last few weeks, we've actually seen a compression between the 10 and the 2, which was kind of like, okay, cool, we're steepening at the same time as not having too much pain, although the stock market did soften quite a bit during that. And all of a sudden, after Jackson Hole, we just went right back down another 20 bips into inversion. So we're like 80 bips inverted right now, basically further away from being uninverted, right? And I think this is happening because if you look, the 2-year skyrocketed, like, I don't know what skyrocketed, it went up, and the 10-year was stable. So after Jackson Hole, the 10-year didn't move much. It was the 2-year that moved. And that's kind of the bond market telling you, okay, we're pricing in yet another rate hike, and we don't think they're going to be that high for the long term. So that's why we see that 10-year stay stable, which it basically aligns with everything that we're talking about here, and this talk from Loretta Mester. So I think, and this is my opinion, I think there's a likelihood we're going to end up getting a Fed that does end up giving us just one more. I think that's going to be a way of the entire board being appeased at the Fed. I don't think it'll come in September. I think it'll come in November. And then that way the Fed can reiterate their confidence. They don't need to do another hike, in my opinion. I think they've done enough, but I think they will give us another in November just to sort of like keep the boot on the neck of the economy going, see, we're serious about inflation. They're not actually trying to make everything more unaffordable or expensive. Of course, that is technically what they're supposed to be doing. What they're doing is they're playing with your inflation expectations. They're like, see, look at that. We went from July to the end of the year, and over those 6 months, we gave you one rate hike. See, we're still in hiking mode. They don't want to send the signal yet that they're done. So just skip a bunch of meetings in between, throw one out over here. You keep the expectations getting pressed down. It's the boot on the neck. That's what it is. They're playing the psychological game. And that's because they know they can cut 2% tomorrow if they needed to. And they will. The question is, how bad is something going to break when that time comes? So hopefully nothing breaks. Obviously, that's the bull POV, is nothing breaks. If something does break, maybe it's a good idea to have a little bit of cash on the side. I'm, believer that having maybe 5, 10, 15% of cash on the side, maybe not a bad idea, but we'll probably keep going with that volatile Nike swoosh. Jack, you want to open the door? Yeah? All right, we're here. Thanks so much for watching. We'll see you in the next one. Bye.